Share screen. All right. Well, good afternoon, everyone. My name is Leola Carter, and I'm your host for today's webinar. I am a SCORE mentor in the Minnesota division, where we have over 90 volunteers serving both Manatee and Sarasota counties. I am also on the education committee and excited to bring to you today's presentation on incorporating a successful succession strategy into your business plan. But before that, just a little bit more about us here at SCORE. We are a nationwide nonprofit that is a part of the Small Business Administration. What SCORE can do for you? We can help in any stage of the business process, all the way from the very first thought, all the way up through where it is time to sell. We provide free mentoring and educational services, such as this webinar. To find us, you can visit score.org/Minnesota, where you will find all of these services. And today would not be possible if it weren't for our community partners and sponsors that we have listed here. Thank you to those organizations. And now it is time to introduce Russell, I'm going to say your last name right, Skibicki, with Raymond James Financial, having more than 10 years experience in financial planning and investment management. Welcome, Russell.
Thank you.
I will stop sharing my screen and you can begin.
Fantastic. I'm going to go ahead and share the presentation. So just want to give a little additional information about myself. I work at Raymond James, been working here for 10 plus years. Before moving more towards the personal financial planning side, I was a corporate consultant working with our 1099 business owners on succession planning. So I've helped oversee roughly 135 different succession plans, business exits, and then additional ones now on the personal financial planning side. I focus on a lot of business owners because for business owners, the personal and the business plan tends to be pretty interwoven. So it's really a passion of mine. I think this area for business owners is a little bit forgotten about, as you'll see through the presentation. And it's always a great area to kind of interwove in your yearly planning, in addition to just the ultimate exit planning. I will say that for the Beyond the Handshake theme, it's going to manifest itself in two different ways throughout the presentation. The first one is going to be just formalizing the succession strategy. A lot of business owners exit or retire by what I always say accident. They wake up one morning, say, I'm ready to sell the business. I've had enough. Let me now look at how to get out of it and move on to retirement, and really kind of retire by accident, which I'm sure, as all of as successful business owners, the more forethought and education you put into it, the more successful it's going to be. The second way it's going to manifest itself is that I see a lot of business owners just really look at the ultimate deal as a handshake. Now, a lot of the deals I've consulted on would have worked well with just a handshake trust between two business owners, whether they're partners, whether they were former competitors. But at the end of the day, having something in writing is always going to be a best practice. I'm not sure if there's any lawyers on the call, but I'm sure they're going to agree with me from that perspective. So the topics of the discussion, we're going to talk a little bit about the state of business owner succession planning, on how there is a need for it and how it's a little bit put on the back burner a lot of the time. Then we're going to talk about the defense of catastrophic planning. We'll talk how that is, the short term, what happens if you get hit by, I say the proverbial bus, it's a little bit gloom and dreary, so maybe we'll say the proverbial ice cream truck to make it a little bit more fun. And then we'll talk about what most individuals think of succession planning as that long-term exit planning. So exit planning, I call it the perpetual back burner. It's really an area for most business owners that is a little bit, I won't say ignored, it's just that it's not front of mind. And unfortunately, as you can see through some of these statistics, 83% have no written exit plan. That usually means that they really don't have any plan whatsoever, other than at some point I'm going to sell this on to the next individual, and I'll approach that when I get there. More importantly, 93% have no formal life after business plan. We'll talk about how that's important too. It's not just getting to the point of retirement, but really thinking of, how that works with your life and what you're going to do next, because some of those things we need to plan for as we're leading up to that. The great statistic on the left-hand side that really kind of dovetails that a lot of individuals talk about launching the plan, looking at business planning, but very few hours are spent on that final exit. It's really kind of, I don't want to say haphazardly put together for some business owners, but it is. And that's what we're trying to do, especially with this presentation overall, is really put some dedicated time to make sure we maximize how that looks. So why don't owners plan for succession? The number one reason, through my experience, is going to be that first one on the left. It's not revenue producing. I've heard many business owners say, if I don't get, the business doesn't get to a sustainable part where I actually get to the exit plan, it doesn't matter if I plan for the best exit ever if I don't make it past the next 2 to 3 years. Now, while I do put some weight into that logic, at the end of the day, there's a lot of business owners who had the business for 30 years and still say, what, tomorrow my doors might not open. I don't, there's always time to plan for bit exiting, and there's a lot of areas where it actually helps promote your day-to-day business by looking at that business plan. Next one is emotional hurdles. I don't want to think about my own mortality, my own demise. I actually had one individual tell me that they're invincible, so they don't really need to think about the catastrophic planning, that they're always going to be healthy, nothing bad is ever going to happen to them. On the flip side, we have some individuals that really overthink it to an extent. They're not going to think about succession plan until they have the perfect successor, perfect strategy, and that's going to take too much time to figure out at this point in time. So we're not really going to plan for it, or we're going to do minimal planning until that perfect person comes in. And I'm going to talk a little bit about the fun parts of finding the perfect successor for catastrophic planning here in a moment. Then the last two are kind of related, not part of the business plan. It's just something that always falls off. Like you do an offsite twice a year, and there's about 10 things on it. The last one's going to be what happens at the end of the business. We'll just keep that too, and all of a sudden you get to the end of the offsite day where you've done all your business planning for the year, and you ran out of time for that exit plan. And then some just feel there's unaware of a need for it. I'm going to just work until the day I'm ready to retire. And, I'm going to go and find someone to buy the business, and the business is going to be attractive. I'm going to sell for a maximum price. And, I just did that by accident because my business is the best. We kind of want to move away from that kind of informal planning to really put some time and effort into maximizing what that looks like and the efficiencies around it. Going to stop for what I'll call a foundational concept for selling the business. When you exit the business, that means that you're transferring it to somebody else. What is the value, and why is somebody willing to pay you for it and kind of take part in that exit? Ultimately what it is the future cash flows, and particularly of those cash flows without you there. Otherwise, what you'll see kind of on the top of the slide is that what your business, it's not just inventory, physical assets. Now, if you're running an unprofitable business that's losing money, maybe those are worth more, but there still is some value to that underlying business or the inventory there. So we want to make sure that we're really looking at that, and you're at the end of the day, you're getting a lot more money for this part of it rather than this part of it here, the inventory and physical assets. Now, in order to maximize this, we have to have transferability of that. If all of a sudden your business goes to zero because you leave it, there's not much value. You're not going to have anybody really wanting to pay you too much for that. So being able to support all of these notions is very important for the business. The more value you can share, the more that you can tangibly share for it, the more important it is. The one example I like to use is, let's say you have an ice cream truck and you want to sell it. Well, it's okay. Inherently, there is value. People buy ice cream. I'll pay you X amount for it. And you say, okay, I think I do between 100 and 500,000 in sales per year. And the person goes, can I see that on paper in a tax return or something? And then you say no. Well, they're probably going to shade it more towards the 100,000, maybe have a discount because they might not trust you. However, if you can put in paper, hey, this is how much business I do, this is what, the routes I take, and these are the dependable customers, there's going to be a lot more faith in that, and you're going to be able to maximize what that sale looks like and the ultimate value of it. We can talk a little bit about fair value. Ultimately, that's the value that someone's going to be able to pay and buy it for. I can spend a whole probably 10 days
Russell,
on value.
Yep. Can I interrupt for just a second? You're a little echoey. I can hear you and understand you, but it's echoing. I don't know if there's a microphone that you could adjust or turn off, or we could just see if I can make it a little clearer. The only other trick I ever know is if I'm on my laptop, I plug it into the wall, and sometimes that helps. Not sure why. But,
okay, let me see here.
See
Does
if we
that
can get
work better?
Still, it's maybe a little bit better. It's still a little echoing. I'm sorry, keep going.
Okay, we're going to adjust it this way. Does that work?
That's better right there.
Okay, perfect. With that, we'll move on to what I call the stages to exit planning. So this is the business timeline here: formation to retirement. Formation, obviously, when you start the business, retirement is when we're going to exit. When it comes to formation, what we'll talk about here, as I alluded to, is the catastrophic planning. That's going to apply to everybody immediately. There should always be a catastrophic plan. We'll talk about what that is in a moment. And then later, we're going to circle back to this graphic to talk about the actual exit planning and readiness. So catastrophic planning. This is planning for the unforeseeable exit, short-term planning. What happens if you get hit by the proverbial, as I call it, ice cream truck, the death of the business. There's different statistics on how to define it, but 50% of exits are forced. So there should always be some plan on what happens. And unfortunately, a lot of individuals think about exit planning, but very few kind of talk about the short-term illness, death. They say, if something happens to me, somebody else will deal with it. I'm unfortunately going to be 6 feet under. I don't think that's the best way, as I mentioned, to plan for it. There should always be thought of what could happen to your business should something happen. Not just death, but disability as well. It's easier for you to proactively plan for it and make sure that there is a plan rather than somebody else coming to pick up the pieces, so to speak. Same with dissolution, divorce, all of these types of things. It's easier to write in some plans. For dissolution, if you and your business partner have something, guardrails in place in case you need to go your separate ways, it's always easy to write those when you're forming the business or on good times rather than when you're already at odds coming in. Once again, I'm going to say if there's any attorneys here, I'm sure they feel it's always easier if there's a prenup before the individuals get married versus when they come in swords drawn to the boardroom to talk about what comes next. So that's the best way to make it the most seamless and maximize for both parties to have something in place. Now, I like to highlight examples. There's be 2 of these of the price of not planning, especially when it comes to catastrophic. So I'm going to use this example: business owner has strong revenue, a little bit on the older side, looks to retire in 3-5 years, has no catastrophic plan. Really will approach that for exit planning. Has a good, strong business value. All of a sudden, unforeseen illness. They're no longer in the office because they have to spend time away. And most importantly, when they are in the office, they're not thinking about selling because now they're just meeting with the clients that are all on the back burner. Some of the clients see this, they're not getting this level of service. They start leaving for other competitors. So all of a sudden, the value begins to slip. Now, this is really the main part of it, the crux of it, is that unfortunately, this example is actually based off of a real case I worked on. The business owner passed away, and now the successor needs to be found by the spouse. So now she's grieving, not part of the business, knew what the individual did, but didn't exactly know who to turn to, how to run this, maintain it, and how to even find a third party. So now that they spend some time grieving, and in that grieving process, they now have to go and pick up the pieces, find a third party to facilitate the sale. Once that's done, they have to find the third party has to find a buyer for the business. All of a sudden, we're down the line. Clients are not being seen. They're looking other places. They're frustrated. This individual or the spouse is working with a third party, something that she doesn't want to be doing at this point. And now any buyer is saying, "Hey, if I was able to step in on day one, I probably would have paid closer to true value. Now that I don't know how many clients have left, how many more are leaving, I'm gonna I see some have left. I'm going to have to give a discounted value to the business, to the beneficiary. So ultimately, as you can see, the business value here was 250,000, significant attrition and deterioration of value going, which could have been protected if someone was already standing, on the sidelines, ready to step in should something have happened. Additionally, the payment to the beneficiaries were delayed. Now, I'm not sure, or personally, for this case, if the family had cash on hand to bridge that gap, or they were needing this to kind of close out the estate, but either way, it would have been a lot more seamless if that happened on day one. Second one, we're going to say two business partners. I'm sure some of you have business partners that are in the business, equal business partner, another case that I worked on based on a real life example. Unexpectedly, the younger one of the two, it's not always the older one that had something happen and passes away. They had partnership documents on how revenue was split, what the roles and responsibilities partners. These two were in business for about 10 years. They're going to be fair. Now, that fair subjective term is up to debate on what fair is, as you'll see for the third part of this. They ended up getting a third-party valuation, three of them, for the business, but the surviving member said, well, wait a second, now I'm doing all the work, or I have to hire somebody. Plus, there's some of the clients that I worked with that are probably going to leave because I don't have any relationship. They only worked with my younger partner. So I don't want to pay top dollar or, even in the middle of the road. I want the lowest one because I think that's fair for, not only the grief I'm going for, but what I'm going to have to be doing in the business. Secondly, there was no thought about how am I going to pay for this? Let's use the example of the other one, 250,000. I don't think many individuals have that on 30-day notice that they can come up with it. Hopefully many can, but the larger the business grows, the more prohibitive that is. And then finally, what the real crux of this situation was that the spouse wanted a higher valuation, but really the son wanted to be part owner of the business. For this one was something that you could step into pretty easily, but that 50-year-old business partner, was a little bit skeptical of if this 23-year-old coming right out of college could really run the business in the same way, in addition to being an equal partner at the decision table, how they want to run the business. They didn't have the experience to lean on, but had all of the ideas. Was a little bit, green behind the ears. Not to say that all 23-year-olds couldn't step in and keep the business going, but what I've seen more often than not, they need to get a couple nicks and experience before they really can be a true equal partner. But through all of this, aside from running the business, that 50-year-old had to run the business and negotiate the sale of the business and what was happening in the future. So not only a lot of work from a day-to-day perspective, but then when went home, had a lot of sleepless nights, one would say, trying to figure out what was next coming for the business and how to unwind this. I won't say mess, but unfortunately, that's what it looks like. So, as I said, we got to move beyond the handshake. Number one thing that you'll see me state, have as much as you can in writing once you've had a thought about that. Especially if you have business partners, it's easier to sit down and move through that. But if you're a solo business owner just starting up, have some value to the business that's growing, it would be prudent to find somebody that maybe could be a catastrophic partner for you. You most likely would have to approach them with a confidentiality agreement, and say, this is what I'm looking to do. I'm looking to protect my family, my business, something that I worked hard to build. So all my sweat equity isn't for naught. We've seen a lot of individuals say, what, I'm willing to stand in that place for you. It's actually a pretty seamless conversation. A lot of individuals want to be collegiate and want to help individuals out. What to put into that, at. It's not, will you step in? At that point in time, if you have that handshake agreement, yeah, I'll step in, but at what price, what value, how are we going to fund it? Let's kind of hammer some of those details home. So this is the bare minimum of what I usually like to see. Who will purchase it? How are we going to value it? Is it going to be a preset price? If you have a stable business, you can usually go with a preset price. If it's something that fluctuates or is growing, let's talk about a formula, or let's have a third party appraise it. How the payment is made, as I mentioned, some people have cash on hand, most do not. Is there going to be life insurance? We'll talk about that. Is there going to be installment? Is there bank financing? For a lot of these scenarios, historically it was hard to get financing. I work with a lot of banks that are willing to lend in these scenarios for business, not only long-term business acquisitions, but catastrophic step in as well. And then do we put contingencies in here? All of a sudden you're gone. A lot of these individuals wanted to work with you. I'll buy the business, but if some of them leave, I don't want to be holding the bag for it. But if we share in some of the risk, maybe after a year, if some of the value deteriorates, we'll take a little bit off of the purchase price. I'm more willing to do that as a buyer, as a catastrophic partner for you. So we've seen all of these types of plans go in there. There is not one document that I can provide to all of you based on business, based on industry. There's a lot of flexibility for that to customize, what's a win-win for both parties. I also talk a little about stewardship agreements here as well. And that's ultimately somebody steps in and says, instead of you having to go out and find a third party to sell it, I'll just step in. I might not want to buy it myself, but I'll find someone for you for a fee. I've seen that work out as well, especially in catastrophic. And then the most important part, which I've highlighted here, is a rescission clause. I've had some business owners that say, let's say 45 years old, my child's going to be ultimately my successor, owner of the business, but they're in high school right now. Let me name you. Maybe my child is going to become do something else. They don't even want to own the business, but you can step in now, and then at some point I'll rescind it, and we'll move on to somebody else. No hard feelings. I appreciate you serving. If something happened, fortunately, we got to tear this thing up, and I'm nice and healthy. We've seen that with like businesses where somebody, for sake of argument, we're going to say a law practice. There's a similar law practice down the street. They work with them. All of a sudden, there's a little bit of a falling out that. For whatever reason, and they say, thank you, but I found somebody else that I think aligns with my clients more or doesn't align with them in that way. I'm just going to rescind it. These plans are not forever. This is not an ultimate purchase. This is just in worst case scenario in that catastrophic event. So, I alluded to the finding the perfect successor. I've had individuals tell me, hey, I don't want to go with this person because, I don't want them to work with my clients. Well, sir, ma'am, you're 6 feet under. Do you care about more your family having the full value of your business, or do you really care who your clients are meeting with? Usually it's, what, if I ask my spouse, I think that she wants the most seamless way, maximizing, in such hard times rather than, all your former clients are not meeting with the right person in your perspective there. So that's something else that I always like to harp on that gets over that hurdle of that perfect person. And then lastly, obviously, review regularly. Things change. Personally, how the business is, who the successors are. So it's always important to review at least every other year or as life events change. Talk about moving a little bit beyond life insurance. A lot of the individuals I work with say, yeah, I have a life insurance plan in place for everybody that always talks about catastrophic plan. We're just going to fund this by life insurance, call it a day. That is very prevalent. 39% of businesses, it's not the majority, but quite a few have it. But what I found is for a lot of my clients I work with, just isn't feasible for many reasons. The first one is a lot of business owners are in their later years, and it just tends to be cost prohibitive. Especially if it's an encore career, as it's called. Somebody goes from corporate America, wants to move on to being a business owner. At that point in time, if you're 55, getting life insurance for value business really eats into what the profitability of the business is. So there's other ways to do it, whether it's a promissory note, contractually obligated to pay. There's other ways, not just life insurance, Second one is going to be, a lot of solo business owners here. If I'm a solo business owner and I approach someone down the street, we're going to use the attorneys again, and say, hey, can you pay premiums for hopefully me not dying? They're probably going to say, you know what, I don't think that I want to pay premiums for someone I don't know, someone else's business. Is there another way that we can fund this? And what you saw in the previous slide was, future revenues can fund it, a promissory. There's different ways that we can fund these plans in order to keep everybody protected. Life insurance only talks about death. If there's a disability, long-term disability event, that's something that's not going to be funded. Are there other ways that we can protect your business and the value of your business? And yes, there are. And then finally, if there's a fluctuating business value, then it might not be the streamlined way to keep going back to underwriting, keep going back and renegotiating contracts. Can we have more of a plan that grows with our business? The simple answer is yes. Let's, when it comes to catastrophic planning, let's talk about the different ways to achieve it, not life insurance all for nothing. Pause here for a second. There's a lot to think about for that planning here before we move on to the more, I guess, happy retirement planning. So with that, we're going from the catastrophic to now retirement. And all of this is, retirement planning. Towards the end, we'll talk about, you'll think about, what's the optimal strategy, but you want to start planning for that ahead of time. If you wake up one morning and say, I'm ready to sell the business, really your option is selling the business. There isn't to somebody else that's already ready to purchase it rather than training someone. If someone said, hey, I'm 6 months away from retirement, but anybody that's going to be a successor for this business has to take 5 years to train, well, that's not a viable strategy. So we want to think about all of these things as well as measure when you're ready to retire. You don't want to have that sneak up on you, so to speak. Now, benefits of having a long-term succession. As I said, you want to have a roadmap to retirement. And it's going to help with the business planning of the business. How am I setting the business up? Am I setting it up to keep growing right now, or should I have it more stable to have somebody else take it over? That's a very important part of it. It gives you a plan for day to day. Second one is provides clarity to employees. I say employees here because that's usually the biggest stakeholder if they're going to be taking on the business being the succession plan, but it provides a long-term succession plan provides a lot of clarity to other individuals and parties, which we'll see on the next slide. The next reason I love having a long-term succession plan is spotlights on annual income and the value of your business. Obviously, if you want to maximize the sale price of the business, you want to maximize the value of the business at every point in time and have that as a tracking mechanism to show individuals, hey, I didn't just all of a sudden grow to this, that over time, this is a sustainable business that you're buying and are willing to pay top dollar for this business. Also reviews your business risk too. As I mentioned, for catastrophic planning, if you're planning on funding this business for your own retirement or for your families, and something happens to you and you'll have no checks and balances, catastrophic plan in place, that's something that we have to build in there. Not only is it viable in 5 years when I look to retire, but if something happens right now, is it still a viable business? You want to have it viable as much as possible. And then attention to gaps in the plan. I'm going to use the example of, once again, you're having your child come in and be the next owner of the business. I had a case I was working with an individual, and they said, you know what, my child is going to take over the business. This was, I'm going to just use an honest an attorney, just keep with that example. And I said, what is your child doing? Well, they're studying culinary arts in college. I said, okay, is that still a viable plan? And all of a sudden they said, well, I thought that was more of a passion project. In 10 years, they're going to just become an attorney. Well, if they're never planning on going to law school right out of college, they're probably not going to come back and be a viable successor. So let's have a contingency plan. Maybe somebody else that you work with is looking at it. So let's look at maybe potential gaps and how those timelines all work. Talk about clarity. Just a succession plan provides clarity to business partners. That's the number one individual. If you're saying, hey, my business partner is going to take it over in 5 years, but I plan on being here for the next 15 years, well, wait a second. They might get frustrated that you keep telling them 5 years and you never are moving to that. And now all of a sudden, what I've seen, that business partner goes to a competitor, and the business owner is shocked that why did they go to a competitor? They were going to take on this business. Well, they were going to take it on for 5 years, 10 years ago. they're frustrated, they don't have any clarity. Without that clarity, they're going to do what's best for themselves. Family. I'm going to move to the bottom one there too. If your spouse is saying, if you've told your spouse, I'm going to retire in 5 years so we can travel the world, and all of a sudden you're not making any plans, so that's going to create some friction there that we want to have a plan in place for. And then finally, clients. A lot of businesses I've learned say, hey, I don't want to tell my clients I'm looking to retire, because once I do tell them, they're going to go over to competitors. That's not really the case. Or those clients tend to have a feeling. I was actually working with a business owner a couple weeks ago, and I said, you know what? I don't know how to tell my clients. I don't want to surprise them. And all of a sudden I look at their diploma on the wall and it says they graduated college in 1968. I look at the gray hairs on their head and I say, I think they have a plan that you're going to closer to retirement than not. I don't think you're going to surprise them too much on this one. This individual was actually another financial advisor that I've worked with, and I said, hey, do you tell them they should retire and enjoy their retirement? Yes. Do you think any of them are going to be upset that you're looking to do what you've encouraged them to do for the past 30 years of your career? And they said, you know what? I think that they'll kind of understand that, I'm moving to that part of my life. And I said, I think they understand you're already in that to an extent. So it just provides clarity for everybody. And really, what a succession plan at the end of the day provides, this can also be replaced with you. It provides you clarity as where to go. And you'll see in the next slide here, if you don't know where you're going, you might end up somewhere else. One of my favorite quotes when it comes to succession planning. Now, options for succession planning, a little bit more clarity here. Business sale, I'm going to sell the business. But what does that look like? Okay, we can do it, define a catastrophic. We'll have that. Some individuals say, I'm going to work and die with my boots on at my desk. This is where I love. Great. Let's still have a plan for that one. Most individuals say outright sales is traditional. I'm going to work, find somebody to sell it to, or I'm going to bring somebody else as an internal succession plan. Great. Let's move a little bit beyond that. We have all these options. Okay, what does that look like from a business succession standpoint? Which one of these, if we're doing a family succession, let's make sure they're ready to take on the business. If we're going to sell to a junior partner, do we have a junior partner even in the business at the moment? So catastrophic planning, we have these options. Outright sale, we have these options. And internal succession, we have these options. So all this is to say, let's get a little clarity. What are we working towards in our business plan? At the end of the day, if you just want to have an outright sale at the end, you don't have time for internal succession. We're going to wipe all of these out if we're only doing an outright sale. But if it's important for you to bring in a family member, we have to start a little bit earlier. The longer you wait, the less of these options are available to you potentially. Now, to have some concrete steps for succession planning, my first one is put a date on the calendar for retirement. It doesn't have to be an exact date. We can move it, but if you don't have that official date on there, we're going to keep informally working and we're never going to get there. Let's formalize. Let's at least put some penciled in date in there. Next, we'll talk about how it's important to establish your business value. Then think about who wants the business. Important. That might eliminate what some of the next strategies you see are. I'm always going to talk about consulting experts. Someone like me, as I mentioned earlier, I've done about 130 of these, consulted on quite a few more that never closed or ones that were pushed off. Those 130 are only ones that officially exited the business. So we've seen a lot. We can get creative in different ways. Not only me, your CPA, they're going to be an important individual, your attorney. If you're in a highly regulated industry, you're a physician, for example, there's different things to be cognizant of that you might not be aware of. So you want to leverage those different individuals. And then finally, review regularly. You mentioned on an earlier slide, things change. You need to have a mendable plan as things change to be able to look at, say, is this still accurate? Do I need to push my retirement out for these reasons, or do I need to shorten it? Some individuals say, I'm going to push it out just because I have a plan for it. That's not the right reason. That's a very, once again, informal reason on how to plan. We want to have concrete ideas on how we're planning, how we're running the business. So we're going to talk about exit readiness. When are you ready to exit? It's a very kind of theoretical date. Actually, with all we were talking about, I have individuals call me sometimes and say, "Hey, I'm ready to exit the business." Well, why are you ready? Well, yesterday I turned 65. Okay, well, when you were 64 years old and 354 days, were you ready? No, but I had an arbitrary date. Okay, that's not how we like to consult. That's not a tangible process that's repeatable for you. That's not something that is great way to run your business. Let's make sure you're ready, and we can push this out or bring it closer in for however we can do it. Now, what are the considerations? Are you mentally and are you financially ready to sell the business? And then also, as we talked about, is it transferable on one of those first slides? Always, the owner of a business has, there's no ugly baby. My business is always amazing. It's funny how that works, that every single business owner feels that they can get the maximum for their business. Let's confirm that with some quantitative metrics here that we'll talk about from the valuation process. And because any business is either go for a premium if it's actually really good, or go for a discount if there's some areas that we can improve on. So I like this little chart here. There's financial and mental readiness. Everybody, when they start out, when they form a business, they're not financially or mentally ready. They're going to stay and grow. That's a simple one. The next one that we see is they get me out the highest price. When you're mentally ready to go, but not financially ready, you tend to get the highest price, but you haven't potentially maximized value. There's a lot of things that you could do, and I don't love heading this way as a business exit. The way I like to have clients go is to move up financially, but stay in the mental readiness. Hopefully, many of you will go in this direction. Hopefully, a lot of you are already here. You're well off. You're financially ready, but you choose to work. And then finally, you move into the final quadrant, which is the wealthy and ready to exit. So this is the route we want to go, not this out of the business. Because once you're mentally ready, doesn't the financial rate might keep you a little bit longer in, but what I've seen from experience, this is the one that finally is when that final shoe drops for the business. So I'm going to start with the mental readiness. Unfortunately, I'm not a psychiatrist. I'm not the one that can walk a lot of individuals through this mental readiness. It's very hard to push somebody to be mentally ready. That's a personal decision. But there are a lot of questions that come around the mental readiness. How do I let go? What will I do with my free time? I've had a lot of individuals that come to me and say, I don't know what I'm going to do with my free time. I'm going to keep working. Fantastic. I have ones that say, I don't know, but I'll figure out when I sell. Those individuals boomerang right back into the industry, right into the business. They all of a sudden start hanging out at their former business, just twiddling their thumbs, second guessing all of the decisions because no one's going to do it the way they would do it. And it frustrates them, it frustrates the successor or the buyer of the business. Does my successor have what it takes? This is something that we can plan for. Let's have a run out to make sure they're ready for the business. And once you know for the business. So all of these things are happening in the business. There's a lot of things that I can talk to. Is there any way that I can mentally get somebody ready for them? No, that's a highly personal decision, but we can at least get you financially ready with a business plan. That's what it is. A business plan talks about the business, talks about the finances. So financially ready, first one that we have is the wealth gap. So here's the value of your business. Here's what amount you need to retire. Well, these two need to match right here. As you can see in the statistic, the vast majority of small business owners intend to sell their business to fund their retirement. Some 100%, some only 50%, but at the end of the day, it's a major component of that. Now, what amount do you need to retire? This is where a lot of individuals know what that amount is. Some business value is above the amount ready to retire, and that's fantastic. But if you need help with that, this is where you work with financial advisors to really hone in on that exact amount so we can see the relationship between your business and the amount you need to retire. Now, is your business ready? This is the one that I always love. 56% have a good idea of what it's worth, but 18% have confirmed it. This is one of those, of course, I know what my business is worth, and what I've learned, they usually think it's worth a little bit more than it actually is from an unbiased third party. For all negotiations that I've had with business owners, the selling owner always feels it's worth more, and the buying owner always thinks it's worth less. It's kind of funny how that works. A lot of real estate agents tell me that they've seen the same with their clients with their house. So this is something where we want to objectively confirm what the business is worth. And needless to say, 46% don't even have any idea what their business is worth, which always scares me because, one of the great ways to make business decisions is ways to improve the business. A lot of time cash flow works in conjunction with that, but sometimes you don't want to improve cash flows, we'll see in a second, and not improve the value of your business. So this is really the biggest part that I always like to look at. Now, increase the value of your business. We want to do a formal increase of value, not just handshake. Everyone says, okay, it's easy. You grow the revenue, cut the costs. We want to grow it in the right way. We want to have a plan. We want to formalize what our business plan is to increase the end value of our business. As simple as that. So as I mentioned, some individuals say, I want to do a one-time sale, all of a sudden it's going to make my business look good. It might make your business look good for one day, but all of a sudden, if I'm as a buyer reviewing your historical revenue and I see all of a sudden a spike, I'm going to ask what that spike was. If it's not repeatable, I'm not going to put much weight into that. We want to have a nice trajectory of the business. And we don't want to do one-time things that potentially damage the long-term viability of the business. So, as I always look at, if I were buying, what would I value? Let's either look at it from an objective sense. If I was buying a business, would I want to see this? Or let's get a third-party valuation, look at what factors drive value in my industry and my business in order to really focus on those. Usually, if you increase the value, you're also increasing your take-home pay as well, simple as that. So that's something that, as part of your short-term business planning, you can help promote the long-term value of your business. Now, this is a fun one where we talk a little about financially, but also a little bit about the mental side. This quote, all owners know the number they need to exit and live comfortably, but given the choice, they're going to stay in. This is one of the fun examples I see of a little disconnect. Current income from the business, let's say you're doing very simply 100,000 expenses are 80%, you're bringing home 200,000. Now you sell the business for 2 times the value of it, so doubles the value revenue, 2 million, taxes of it, not tax advice, just a quick long-term capital gains. You bring home 1.6, and now on a yearly basis, without taking out any of those proceeds, you're getting a 5% conservative coupon. Everybody says, why would I leave the business to get 80,000 when I can have 200,000? Well, the big disconnect is here, you're working 40 hours a week. Here, you're sitting on a beach sipping, beverages that have an umbrella in them. So, but a lot of individuals say, well, I only work 10 hours a week at the moment, so I'd rather work 10 hours, get this amount, than work 0 hours and get this amount. Okay, great. Well, we need to look at all of your finances and see, are you ready for retirement? Because that's a mental aspect. But if these numbers are different, where your business value isn't enough to even kick off to live somewhat, something that we're going to have to look at. So the finances of the business, as well as your personal finances and retirement plan, once again, there's a big overlapping shade of how we look at your business plan and your personal financial plan, especially for small business owners. Not as much the case for someone at Apple like Steve Jobs. Now, once again, we're going to talk about the beyond the handshake. Let's have your plan in writing. Okay, I'm going to maximize my business. I'm going to do all of these things. I'm going to increase revenue. That's not a good business plan. Let's put it on paper. Let's have achievable goals. Let's make sure that these goals work with it. I need to sell my business in 10 years, but I want to be out in 5 years. That doesn't work. My wife wants me out in 10 years, but I want to be out in 5 years with this business. Okay, let's talk about a little bit of that. Do we have enough income to bridge those gaps? What are we going to do? Now, let's talk about the actual purchase agreement. Who will purchase how value? A lot of this is similar to a catastrophic plan. At the end of the day, you're transferring ownership of the business. So these things are going to be similar. Review it regularly. You've heard that as well. Sales specific. These are other things. Consulting agreement, non-competes. Non-competes usually aren't as integral for if you got hit by the proverbial ice cream truck. Probably not competing from 6 feet under. Apologize for my cavalier attitude towards it. In this business, we deal with it a lot. That got a little bit rosy-colored a lot. But consulting agreement. I'm going to harp on this one for beyond the handshake. Had a lot of advisors that say, okay, sell the business, that's all hammered out. Now this individual, there's going to be some time where he's introducing me to clients, introducing me to business processes. Fantastic. That's what it's going to look like. Well, they shook hands on it. They didn't have, what's that expectation? One of the examples I had for an individual that said, okay, you're going to be available. It was a one-liner in the contract, very informal. You're going to be available. This individual moved across the country on the second day of closing. Buyer calls up successor, says, hey, are you going to be available? Says, I'm on my cell phone. I'm available. You never said I had to be available in person. He said, well, that wasn't my expectation. The guy goes, yeah, well, you should have gotten it in writing. That's going to be a little bit of friction. That kind of hurt overall the success of the transition, which hurt the value of the business because there was a little bit of attrition in those underlying clients. We don't want to, we're not able to look at every single scenario, but we at least want guardrails to make sure we're aligned in those expectations around transition agreements, consulting services. Even, I've said it in a business, the art on the wall. One individual said, you're paying me for this art. The other one said, you can keep the art, but we're going back and forth in those little details on what the value of the art is, who's keeping it, and what that looks like. So we want to look at those types of things. Good attorneys, good consultants can talk you through some of the scenarios they've seen. I don't want to scare everybody, but because the vast majority of these work, a lot of them do work handshakes, especially in old business. But I call it the carrot and the stick. You want to have the carrot where we trust the person taking over your business, but you want to have a stick in case things happen from that perspective, things to fall back on within the plan. After all, this is beyond the handshake. That's what we're harping on. So 4 quick takeaways before we open it up for questions. 1, you've heard it 100 times. Don't handshake on, have a written plan. The more thorough it is, the better it is. Both for catastrophic, if you're not yet at the selling point, but otherwise long-term planning. How do you get to that exit? Know what your practice is worth. Always have a gauge. You don't want to be surprised and have to make up some time. Be ready for retirement. It's a hard thing to do, but it's always important. And then obviously review your plan regularly. This is not a set it and forget it. Things change, family events change, things that change. Let's make sure that we have the ability to amend the plan, be flexible with it up until you do finally exit from that perspective. All important things. These are my 4 big takeaways. With that, I always love that graphic. Not sure why I've used it for years. It's always fun. So with that, I'll open it up to questions.
And if anybody does have any questions, you could type those into the Q&A and we can get those answered for you. And I did mention to Russell earlier that I've been a small business owner for 26 years and was going to sell and it didn't happen, but I thoroughly enjoyed the presentation. It did continue to echo a little bit, so I apologize for that for the participants, but I was able to hear you. It just had a strange echo to it.
Apologize for that.
And let's see, I have some other closing slides.
Okay, I'll stop there in that case.
Let's see. And then I have that. Let's see. Yeah, so once again, at SCORE, if you need to request a mentor, you can find us at score.org/Minnesota. And would like to thank everybody for participating today. Just to let you know, you will receive a copy of today's slides and video presentation in your email. And then if anybody did have any questions, you can type those into the Q&A. But other than that, we'd just like to thank you for attending. And you will receive a survey in the mail that you can let us know what we can do to improve or what other topics that you may be interested in. And just double checking. It looks pretty good. Well, Russell, thank you so much. I really appreciate it. And have a great afternoon.
Likewise for everyone in attendance. Appreciate the time.
All right, thanks. Bye-bye.